The United States government is currently paying more than $1 trillion a year just in interest on its debt, not paying down the debt, not funding programs, not building infrastructure or investing in anything, just covering the cost of having borrowed the money in the first place. That number, over $1.2 trillion in fiscal year 2025 alone, is now larger than the entire defense budget. Larger than Medicare. It trails only Social Security as a share of total federal spending. And unlike those line items, it buys the country absolutely nothing. It's a maintenance fee on past decisions, a subscription payment for money already spent. And here's the part that doesn't show up in headlines. That maintenance fee is quietly embedded in the price of your mortgage, your car loan, your groceries, and the rent you pay every month. Government debt doesn't just live on a spreadsheet in Washington. It lives in your cost of living. And understanding exactly how requires looking at the architecture underneath. To understand why, you need to see how the plumbing actually works. Most people think of national debt as a political talking point, something politicians argue about during elections and forget about afterward. But the national debt isn't just a number, it's a market. The US government borrows money by selling Treasury securities, bonds, notes, bills, to investors around the world. Banks, pension funds, foreign governments, hedge funds, regular people with retirement accounts. All of them are lending money to the US government in exchange for a promise: we'll pay you back with interest. As of early 2026, that total outstanding debt sits at roughly $38.4 trillion. But the raw number isn't what matters. What matters is what happens in the market where that debt is bought and sold, because that market, the Treasury market, is the single most important pricing mechanism in the global financial system. It's the base layer. Every other interest rate in the economy is, in some way, built on top of it. Here's the chain. When the government needs to borrow, it issues treasuries. Investors buy them at auction. The yield on those treasuries, essentially the interest rate the government has to offer to attract buyers, becomes a benchmark. It's the risk-free rate, the floor of the financial system. And the most important benchmark of all is the 10-year Treasury yield, which right now hovers around 4%. Why does that number matter to you? Because lenders use the 10-year Treasury yield as the foundation for setting mortgage rates. They take that yield and add a spread, typically 2 to 2.5 percentage points, to account for the additional risk of lending to a homebuyer instead of the US government. That's why 30-year mortgage rates have been hovering in the low to mid-sixes. It's not because your bank decided that's a fair rate. It's because the government's borrowing cost set the floor and your rate was built on top of it. The Fed cut interest rates multiple times in late 2025, and mortgage rates actually rose during some of those cuts. That confused a lot of people. But it makes perfect sense once you understand that mortgages track the 10-year Treasury yield, not the federal funds rate. The Fed controls overnight lending between banks. The bond market controls long-term borrowing costs. And when the government is flooding that market with new debt, the bond market demands higher yields to absorb it all. But it doesn't stop at mortgages. Auto loans, corporate bonds, credit card rates, business lines of credit, they all reference Treasury yields, either directly or indirectly. When the government's borrowing cost goes up, borrowing costs go up for everyone. Not because anyone decided to raise rates on consumers, because the base layer shifted. Now here's where the mechanism gets interesting. The US government doesn't just set the benchmark rate, it also competes for the same pool of money. Every dollar an investor puts into Treasury bonds is a dollar that isn't going into corporate debt, small business loans, or mortgage-backed securities. Economists call this crowding out, and the scale of it is staggering. US Treasuries now account for roughly $28 trillion of the country's $47 trillion fixed income market. That's about 60% of all the bonds in America. The government is the dominant borrower in its own economy. The Congressional Budget Office estimates that for every additional dollar, the federal deficit increases. Private investment drops by about 33 cents. 1/3 of the borrowing capacity that could go to businesses building factories, hiring workers, developing technology, absorbed instead by the government refinancing its own past spending. That's not a crisis. It's a design constraint. The system is structured so that as government borrowing scales, it naturally compresses the space available for private investment. And compressed private investment means less competition, less innovation, and eventually, higher prices for consumers. Think of it like resource allocation in a strategy game. There's a fixed pool of capital in the economy. The government claims a growing share of that pool. Private borrowers have to compete harder for what's left, which means they pay more. When a company pays more to borrow, that cost doesn't vanish. It gets passed through, into the price of goods, into the cost of services, into the rent on the building the business operates in. The landlord's mortgage rate was higher because Treasury yields were higher. The business's loan was more expensive for the same reason. And by the time you walk into a store or open an app to order something, all of those compounding borrowing costs are baked into the price tag. This is the part most people miss. Inflation isn't always about too much money chasing too few goods. Sometimes it's about structural costs embedded so deep in the system that no one traces them back to their origin. Government borrowing costs are one of those invisible inputs. They propagate through the entire economy like a background process you can't see in the task manager, but that's eating your system's resources. And the math is getting worse, not better. 5 years ago, the average interest rate on US government debt was about 1.6%. Now it's over 3.3%. That doesn't sound like a dramatic jump until you apply it to $38 trillion. The result? Interest payments have nearly tripled in 5 years, from roughly $345 billion to over $1.2 trillion annually. To put that in scale, the government is now spending more on interest than it spends on defending the country. That's money that must be spent before it funds a single road, a single school, a single military deployment. And every month, that interest tab grows by more than $21 billion in payments to trust funds alone. Because the deficit keeps growing, projected at over $2 trillion a year for the next decade, the government has to keep issuing more debt, at whatever rate the market demands, just to cover the interest on its existing debt. It's paying debt with more debt. A self-reinforcing loop with a compounding cost. The debt limit was just raised by $5 trillion in mid-2025 to a ceiling of $41.1 trillion. That ceiling won't last long at the current rate of accumulation, roughly $8 billion a day, or about $93,000 every single second. The more it borrows, the more Treasury supply floods the market. The more supply, the higher yields investors demand to keep buying. The higher yields go, the more expensive everything gets, for the government and for you. Meanwhile, each new dollar of debt crowds out a little more private investment, a little more productive capacity, a little more economic oxygen. Most people hear national debt and think, that's the government's problem, politicians will figure it out. Or they won't, and someday there'll be a dramatic reckoning. But that framing misses the point entirely. The debt isn't a future problem waiting to explode. It's a current cost being distributed across the economy right now in real time through the interest rate architecture that prices everything you borrow and much of what you buy. There's no single moment of collapse. There's just slow, compounding pressure that accumulates so gradually, most people adapt to it without ever noticing the source. The cost of housing stays elevated not just because of supply and demand, but because the base rate everything is priced from keeps getting pushed higher by the government's own borrowing needs. Affordability erodes not in one dramatic crash, but in a steady, structural grind that looks like normal market behavior unless you trace the wiring back to its origin. And this isn't just an American phenomenon. When US Treasury yields move, global borrowing costs follow. The 10-year Treasury is the benchmark not just for American debt, but for sovereign and corporate debt worldwide. When the US government's cost of capital rises, it pulls up the cost of capital everywhere. Businesses in other countries pay more. Consumers in other countries pay more. The architecture is global. Understanding this doesn't mean the system is about to collapse or that you should panic. It means recognizing that the cost of government debt is already priced into your life in ways that are invisible but measurable. Every percentage point on the 10-year yield ripples out into mortgages, car loans, business costs, and consumer prices. It's not a future risk, it's a present mechanism. If this kind of breakdown changes how you see the financial system, consider subscribing to 8-Bit Economics. Every week, we strip complex systems down to their core mechanics. No hype, no predictions, just the underlying code that drives how money actually moves. Hit subscribe, and if this video shifted your thinking, leave a like. Drop a comment with what you'd want decoded next. By the time everyone sees it coming, the smart play is already over. Here's the thing worth sitting with. The $38 trillion national debt doesn't have to go to zero for it to affect your daily life. It doesn't have to trigger a crisis for it to cost you money. It already is. Every time the government rolls over its debt or issues new bonds, it resets the base rate of the economy. And every time that base rate ticks higher, it quietly reprices everything built on top of it. You'll never see a line item on your receipt that says government borrowing surcharge. But it's there, in the mortgage rate you locked in the car payment you're making, in the rent your landlord is charging to cover their own financing costs, in the price of the product from a company that borrowed money to build the warehouse it ships from. The price of government debt isn't something that happens to the government. It's something that happens to you. And the system isn't broken. This is exactly how it was designed to work, which might be the most uncomfortable part of all.